Welcome back to Blue Collar Retirement. In this series, we focus on real topics that come up as people move through retirement planning. And today we're talking about long term care insurance. This is one of those subjects that many people have heard about, but often don't fully understand or sometimes avoid thinking about it altogether. But the reality is, long term care is one of the biggest financial and personal risks people face later in life, and understanding how it works is an important part of being prepared. Long term care insurance, as we know it today, is relatively modern. The first policy was offered in 1974. For most of human history, long term care needs were handled within families. It was common for adult children or relatives to care for aging parents at home. Over time, as families became more spread out geographically and life expectancy increased, the need for formal care services grew. Nursing homes and assisted living facilities became more common, and with that came rising costs. Government programs like Medicaid began to cover some long term care expenses, but only for individuals who met strict income and asset requirements. As a result, private long term care insurance developed as a way for individuals to plan ahead and help cover these potential costs without relying solely on personal savings or government assistance. The main reason people consider long term care insurance is to help protect against the cost of care later in life. Long term care is not typically covered by standard health insurance or Medicare beyond short term situations. If someone needs extended care, whether in a facility or at home, those costs can add up quickly. People purchase long term care insurance to help protect their savings, reduce the financial burden on family members, and maintain more control over the type of care they receive. It can also help preserve independence by providing options for care settings, such as receiving assistance at home rather than moving into a facility. At its core, long term care insurance is about planning for a situation that may or may not happen, but could have a significant impact if it does. When we buy life insurance, we are providing for survivors when we pass away. This is ensuring from the risk of mortality. Long term insurance covers a different type of need. It protects from the risk of morbidity. Morbidity is when there are aspects of life that we can no longer take care of ourselves. Issues like being unable to feed ourselves or getting out of bed. Dementia is another problem that might need long term help. One of the reasons long term care insurance can feel confusing is the terminology. There are a few key terms that are important to understand. The benefit amount refers to how much the policy will pay, often expressed as a daily or a monthly amount. The benefit period is how long the policy will pay those benefits once care begins. For example, the policy may have a daily benefit of $200 per day. The length of time the policy will pay is 3 years. The total value of the policy is $200 multiplied by 1,095 days. So the total value of the policy is $219,000. This does not mean that all of the funds have to be used or lost in 3 years. If the daily need is only $150 per day, then the policy will last longer. Policies can also be quoted as monthly amount, and the same principle applies. One choice that might be available is a shared policy. This is where both the husband and the wife have access to a shared pool of money. This can help keep the costs down and may help if one spouse has some health conditions that may disqualify them on their own. When I started this business 20 years ago, there were policies that had an unlimited benefit. It would cover long term health needs with no time expiration. These policies, though, are no longer available. Today, policies are generally available for a time period of 3 to 5 years. Another important term is the elimination period. The elimination period is similar to a deductible, but based on time rather than money. It's the number of days you must pay for care out of your pocket before the insurance begins to pay. One popular elimination period is 90 days. This means that you will be required to pay all of the cost for the first 90 days. So if the cost at the facility is $200 per day, you would need to pay for the first $18,000 of expenses. The longer the elimination period, the lower your premium cost for that policy. When you select your elimination period, you also want to consider how you covered those initial costs. Another important concept is the trigger to pay benefits. Most policies require that a person be unable to perform a certain number of activities of daily living before the benefits are paid. There are generally 7 activities of daily living that are considered. Those activities are bathing, dressing, eating, transferring or mobility, using the bathroom, and continence. For most policies, if you cannot complete 2 out of these 7, then your policy can be activated to begin paying. Cognitive impairment, such as dementia, can also trigger benefits under many policies. Inflation protection, called an inflation rider, is another feature often included or added to a policy. Because the cost of care tends to rise over time, this feature increases the benefit amount to help keep up with future costs. There are 2 ways to look at an inflation rider. The increase can be a simple or a compounded rate. A simple inflation rider means that the benefit of the policy will rise by the same value every year. For example, the total value of the policy is $200,000, and it has a simple inflation rider of 3%. This means that the value of the policy will increase by $6,000 per year. A compound rate rider will increase the policy every year by the percentage of the rider. Let's use the same values from our previous example. The policy is worth $200,000 and the compound rider is 3%. The value is the same for the first year, an increase of $6,000. But in year 2, the policy will increase in value by $6,180. The value of the policy will grow faster with a compound inflation rider. It's important to make sure that if you are purchasing a policy, that it is clearly stated how the inflation rider is designed. Understanding these terms is essential because they directly affect how a policy works and how useful it will be in the future. One of the issues with long-term care insurance is that your cost for the policy may go up. When you purchase a policy, you are in a large group of policyholders. If the cost for that group is rising for the insurance company, they have the right to raise your premiums. Some people who have had policies for more than 10 years are now seeing cost increases of more than 10% every 3 or 4 years. Long-term care insurance has evolved over time, and there are now several types of options available. Traditional long-term care insurance is designed specifically to cover long-term care expenses. You pay premiums, and if you need care that meets the policy's conditions, the insurance pays benefits. One consideration with traditional policies is that if care is never needed, the benefits may never be used. There are also hybrid policies, sometimes called asset-based or linked benefit policies. These combine life insurance or annuities with long-term care coverage. In many cases, if long-term care is needed, the policy provides benefits for that purpose. If not, a death benefit may be paid to the beneficiaries. Each type has its own structure, cost, and considerations, and the right option depends on an individual's financial situation and goals. Not everyone chooses to purchase long-term care insurance, and there are alternative approaches. Some individuals plan to self-fund, meaning they rely on personal savings and investments to cover any future care cost. This approach requires having sufficient assets and being comfortable with the potential financial impact. The cost today can be significant. For in-home care, that cost can be between $25 and $35 per hour. Assisted living has risen to between $6,000 and $8,000 per month. The most expensive care is skilled nursing. Many facilities today are over $120,000 per year. Others may rely on family support, although this can place emotional and financial strain on loved ones and may not always be practical. A feature that some policies have is the ability to have a family member certified to provide care. When the family member is certified, the policy will pay them to allow the policyholder to remain at home. Medicaid is another option, but it's designed as a safety net and comes with strict eligibility requirements. In many cases, individuals must spend down a significant portion of their assets before qualifying. Some people also use a combination of strategies, balancing savings, insurance, and other planning tools to prepare for the possibility of long term care. Long term care planning is closely connected to estate planning. Without preparation, the cost of care can reduce the assets that would otherwise be passed on to family members. Some individuals use insurance to help protect their estate by covering care costs, allowing other assets to remain intact. Others explore legal structures, such as certain types of trust, to help manage and protect assets while planning for potential care needs. The goal is not just to prepare for care, but to do so in a way that aligns with broader financial and family goals. Long term care is one of those topics that it's easy to put off because it involves uncertainty. No one knows if or when they will need care, how long it's going to last, or what it might cost. But the impact, if it does happen, can be significant. Planning ahead doesn't mean assuming the worst. It means being prepared so that if care is needed, there are options available and decisions don't have to be made under pressure. In blue collar retirement, we focus on practical understanding. Long term care insurance is not the right solution for everyone, but it is an important topic for everyone to consider. Knowing how it works, what options exist, and how it fits into a larger plan can help you make more confident decisions about your future. And like many parts of retirement planning, the goal is not just to build wealth, but to protect it and to make sure it supports your life and your family in the years ahead.
Safety First Retirement, ensuring your financial dreams.